Alright, what is going on, guys? It is Stocks Noah back at again with another video. Today, as you can tell by the title, I'm going to be covering just, the big four hyperscaler earnings, and everything that kind of just confirmed about the AI super cycle that we're in. Alright, firstly, I just want to talk about my free newsletter that I send out every day. Funny enough, not to toot my own horn, I released this newsletter at about maybe 11 p.m. today when everything was kind of down a little bit, and I was calling for a fire sale on some specific stocks. I was calling them, buy the dip on Microsoft. I said, we're looking at potentially seeing a bounce off of the 400 level, maybe some selling pressure towards there, and then a bounce upwards. So if you see it hit 400, maybe a little less, look for buys. I covered, all the reasons that Microsoft went down after posting insane earnings, right? I talked about, maybe look to buy Amazon. Their earnings were absolutely nuts. Look for potential buys around the 255 area. And as you can see, it completely bounced right off. So if this is something you guys are interested in, I post stuff like this every single day. I'm really getting into it. It's completely free. It's going to be in the link in the description here. So I'd love for you guys to check that out. It's just, something I'm really just trying to work on. And I just love doing it. So if it's something that's interested, it's free of charge, like I mentioned. So please go take a look. Don't be scared to, join the community. And yeah. Without further ado, guys, I just want to jump right into this because your time is valuable. I'm going to get into, the quick little rundown so we're on the same page here. Let's take a look at Alphabet quickly. So for Google, what an amazing stock. They had a 10% run up today, which was absolutely insane. But because of this, we know Google was the clear winner from today, right? They had revenue of $109.9 billion. They're up 22%. Google Cloud absolutely exploded. They had $20 billion in revenue, up 63% year over year. The cloud backlog nearly doubled quarter over quarter to $462 billion. Just an absolute quarter overall. And because of that, they raised CapEx from 180 to 190 billion for 2026. And their stock rewarded 10% from that. Now for Amazon, the quick little headline numbers, they crushed it on AWS. They're already the biggest cloud computing company in terms of market share, and they crushed it even harder this quarter, so it was really great for them. They had revenue of 181.5 billion, AWS at 37.6 billion and growing at 28%, which is the fastest AWS growth in 15 quarters, right? But the stock dropped, actually. It was down about 3% intraday, because the CapEx hit of 44.2 billion in a single quarter kind of spooked investors, and they reaffirmed, 200 billion for the full year. So these companies are not slowing spending, but that might have spooked investors, and in my opinion, it was a little bit overblown. And a lot of people have agreed with me because, there's a lot of, dip buying there. Now let's go take a look at Meta, which was, in fact, the biggest loser of the day, down almost 10% total at one point, finishing only down 8.55%. We saw some, a lot of people buying the dip at one point. So, they beat on revenue at 56.3 billion. They're up 33% on that. They had the fastest growth since 2021. But the stock got hammered today, after hours, especially right when the print dropped. And that's because they raised their 2026 CapEx from 115 to 135 billion to about 125 to 145 billion in that range. So that's why it really spooked investors. Also because they are having a lot of troubles, with, the Reality Labs part of their business. It's constantly burning money. And a lot of people are bringing up concerns about Mark Zuckerberg because he has a lot of projects that seem to be canceled or, burn a lot of money. So, yeah, there are some concerns with that. I'm going to obviously clear up everything. But now for my personal favorite one, Microsoft. They beat earnings by 4.27 EPS versus 4.06 expected. They had revenue of 82.9 billion and Azure guided up to 40%, right? Next quarter, above 37% consensus. So they guided 3% higher, right? And Copilot hit 20 million paid seats, but they also raised CapEx to 190 billion, citing higher memory and hardware cost pressures. And the stock traded down at one point down 5 to 6% because of that. Absolute overreaction. Now, one thing I want to clarify, you may be saying, oh my God, 40% growth for Azure. It's not really that much when you look at Alphabet, who had, 63 billion. You have to understand as well, Microsoft scales a lot larger than Alphabet's in terms of market share. And, they have the most data centers. So that's another thing too. The fact that they're able to do this in a supply constrained area, giving Azure growth better than consensus and high revenues, I think that's honestly insane. And another thing that's very misconceived about, the AI CapEx, a lot of people are going to paint a false picture and a false narrative around it. But you have to understand, businesses have to pay money and spend money to make money. You know what I'm saying? They can't just magically get money back on their artificial intelligence without expanding exponentially. And they're obviously doing this, and we're now seeing returns on investments for that, right? So that's why Meta got hammered a lot harder, because they weren't seeing, potential returns on investments that, these other companies could be seeing, because they're not really too intertwined in, selling the artificial intelligence as the other three are. But, I'm going to dive into that a little bit later. Now I just kind of want to talk about why Google actually went up. So I've been calling in my news reports and all my other videos about Google, citing strong growth in their TPUs and custom silicon, and, growth in their Google Cloud, projects. So I've been really talking about Google for a while, and I've been, calling on it for being a great company. And they were the absolute winner of today. And, the reaction tells you that exactly. Google delivered, the trifecta that nobody else kind of fully cleared in this earnings report. First, the cloud growth. It was 63%, absolutely hammering expectations, way ahead of, Microsoft's and AWS's. Second, that $462 billion backlog is the cleanest demand signal you'll ever see in cloud, right? So that means that management, they also said over half of it converts to revenue within the next 2 years. So that's $230 billion in locked-in cloud revenue starting at investors, staring at investors, rather, my fault. Third, this is the really interesting one, and this is a part that actually really moved the stock, in my opinion. Their operating margin expanded to 36.1%, even with CapEx up 107% year over year. And that is margin leverage at its finest during the heaviest infrastructure build in their entire company's history, while also being in a supply-constrained environment, right? So to kind of take that corporate speak into some stuff, everyday people will understand, what that means is that, Google can prove that you can spend massively on AI and still expand margins at the same time. That's literally the holy grail of what investors look for, right? That's something I look for personally. And, every other hyperscaler is kind of showing, margin compressions to a degree to kind of fund their AI build out. But, Google is showing margin expansion, which is very interesting. That's why the CEO got a 6% pop in his stock, essentially. You know what I'm saying? So it was extremely interesting. And the reason why the CEO attributed to the 6% pop is because he answered the only question that Wall Street has been asking for a year, right? When does the AI CapEx actually pay off? And he answered it by saying right now. So that's why, Google was the clear winner for today. And rightfully so. Great company. I'd love to, get more exposure to them. And I think their GPUs are going to change the world. So, yeah, great earnings report for them. Now, in this next segment, I want to talk about, why Microsoft, Amazon, and Meta actually went down a decent bit. And why it doesn't make sense. So first things first, starting with Microsoft, I'm going to be talking about the bear case that investors kind of intraday, started bringing some light to, and why it's flawed. So there's two big concerns that went on Microsoft after a little bit of research I've conducted. The first one, I believe, is due to increasing competition. This is the only logical one that really makes sense to me. So, the new OpenAI deal ended Microsoft's exclusive cloud arrangement with OpenAI, meaning, Amazon and Google can now host OpenAI workloads when before it was exclusively for Microsoft and Azure. Bears immediately read this as, Microsoft losing its AI moat. And, combine that with Google Cloud growing at an exponential rate versus Azure's, 40%. And the narrative kind of writes itself. Google's beating Azure, so why would we invest in it? We're just going to cycle money into Azure. But in my opinion, that read is extremely lazy. Microsoft, they kept a license on OpenAI's IP, right? So it's royalty-free through 2032. The CEO literally said they fully plan to exploit that deal. That's 6 more years of building products on frontier AI, without paying any sort of royalties. Meaning, Google's 63% cloud growth is also off a very minute base compared to Azure's. So what I mean by this is the reason why they're poised to have such big growth is because firstly, they have a way smaller run rate for their cloud business, and Google also has way less market share than Azure. Not a lot of people talk about that, but something I found interesting is that I believe Google Cloud actually has 11 to 15%, and Azure has about 22 to 24% of the market share. That's the number I'm recalling off the top of my head. But that is definitely in that range in the ballpark to be absolutely true. And to kind of build off of that, like just the sheer scale, Google had 63% cloud growth off a, 20 billion run rate versus Azure's having a 40% cloud growth off of an 80 billion run rate. So the scale is so much higher. The fact that they're growing 40% for Microsoft on $80 billion, they're generating more incremental revenue than growing 63% on 20 billion. So the competition narrative kind of ignores the math and ignores, the exact scale. So I think the competition narrative is overblown. I'm not taking anything away from Google. I'm just simply stating that the overshadowing on Microsoft is completely overdone. Google, great earnings, great company. I honestly think it can go to 450, in my opinion. That's where my price target's at for them. But for Microsoft, I think, after this print, it's unjustifiable to be this low. Second thing that I've come to the conclusion with is that, I think investors were concerned about seat versus consumption concerns on their Copilot platform. So in my opinion, this is the wonkier one, but it is a real worry for investors. The fear is that Microsoft is selling Copilot as a per seat subscription, usually around like $30 per user per month. But the underlying AI infrastructure costs are usage based. So if users hammer Copilot all day, Microsoft's cost scale with usage, but revenue is actually capped at the seat price. So bears worry that because of this, margins will compress as power usage emerges and gets larger. So that is a major concern. But I'm here to tell you why that doesn't really make any sense. First, weekly Copilot engagement is not the same level as Outlook, which is a really big canary for Microsoft's product and showing that they have been monetizing at high margins for decades. They figured out how to run high engagement productivity software profitably before. Secondly, Microsoft is rolling out new pricing tiers. The E7 Enterprise package and Copilot Cowork, which is their new pricing tier, introduce consumption-based components for the heaviest users. They're already addressing that concern that investors are talking about. Thirdly, AI inference costs are dropping roughly 10 times per year as silicon optimizes. So the cost curve is falling faster than usage is actually growing. So the seat versus consumption math gets better over time for Microsoft and not worse. And, as we know, stocks are forward-looking. To me, this doesn't seem so forward-looking. I think they're punishing them for, something that's extremely overblown in the short term. And I think I think Microsoft is, they're getting punished for it, for problems that, they're already solving or going to be solved in the future. So I think it's completely overdone. Next, I want to talk about is my second favorite company from here, Amazon, actually. And I'm going to be talking about the bear case right now for them, why they went down, and why it's actually extremely flawed. And we saw a lot of buy the dip for Amazon, like I mentioned in my newsletter today. But the main bear thesis on Amazon, is free cash flow collapse. That's the big thing. That's the big thing I saw when I was looking at the report. I noticed, free cash flow, and I want to talk about that, bring some light to it. So Amazon actually reported trailing 12-month free cash flow of just $1.2 billion, which is down from $25.9 billion the prior year, right? So that's a pretty decent drop, in my opinion. But that's a 95% decline, so bears look at that in panic. They're worried Amazon is burning through cash faster than AWS can generate returns, which, as we know, guys, that's completely untrue. Also the $200 billion CapEx commitment, with CapEx growing faster than revenue, makes the free cash flow story look absolutely horrendous on paper. It looks bad. But this read, once again, completely ignores what the CEO said on the call. He explicitly addressed this. He said, and I quote, AWS has to lay out cash for land, power, buildings, chips, servers, and networking gear in advance of when we can monetize it, typically 6 to 24 months before we start billing customers. Then he said, the free cash flow and return on invested capital for these investments are cumulatively quite attractive a couple years after being in service. Now, what does that mean? He's literally telling you the free cash flow compression is a timing issue, not a profitability issue. So once again, stocks are supposed to be forward-looking. This does not look too forward-looking to me. They're punishing them for very short-term, bumps in the road, but in reality, they have the most infrastructure for data center. They hold the most market share, and their stock got punished for that for some reason. Amazon went through this exact same cycle during the first AWS growth wave a decade ago. I don't know if you guys remember that. They burned cash building capacity, then printed money for years afterward. The $200 billion CapEx isn't lit on fire either. It's being deployed strategically against contract demand. So the demand they have in corporate contracts with their companies, that's how they're deploying their CapEx. They're not just, having no sources of revenue in future contracts with companies and just spending like it's coming out the wazoo. No, that's not the case. They have these contracts coming in, so they're spending their CapEx strategically. OpenAI also just committed recently 2 gigawatts of Trainium capacity. Anthropic committed up to 5. So that's a lot of capacity. The chip business hit a $20 billion run rate, growing triple digits. So this isn't speculative spending. It's spending against signed contracts, right? So it's all strategic. The Bears are looking at, kind of one quarter for Amazon's free cash flow in isolation. And they're kind of missing out that Amazon's customer commitments lock in the returns, right, through contracts. And the market is treating CapEx like an expense when it's actually pre-funded revenue. That's the misconception. CapEx, sure, it's an expense, but it's very different because in reality, this will get turned into pre-funded revenue, right? So I want you guys to, reshape how you think about it. And the last thing I'm going to talk about that went down today, that kind of got destroyed, is going to be Meta. Let's go take a look at Meta's stock on TradingView here. Don't mind all the lines here. I will delete a few just so it's a lot easier for you guys to look at. But yes, all right, as you can see on here, it bounced beautifully off my 603 line and, shot right back up. A lot of buy the dips, hit that liquidity zone and, shot right back up. Yeah, so if you guys want stuff like this, some information, please go check out my newsletter. Once again, it's absolutely free. Sorry to plug that. I know your time's valuable, so we will jump right into this right now. So I'm going to talk about the Meta bear case and why it's also flawed. Now, before I just want to preface, it is flawed, but, Meta has a lot more flaws than the other 3 companies that I mentioned before. So take that with a grain of salt. But I'm going to be talking about how Meta got punished the hardest. They finished the day down like 8.5%. So the bear thesis here, from the research I've done, is, return on investment uncertainty on the Reality Labs and AI CapEx without a clear monetization timeline, right? So that's a big issue. Meta raised CapEx by another $10 billion at the high end, citing higher component pricing. Bears see that and actually worry, right? So Meta doesn't have a cloud business to monetize this infrastructure, actually. They're not selling AI to enterprises like, AWS or Azure. So what's all this capacity actually for, you may be wondering? And meanwhile, Reality Labs is still bleeding money. The metaverse pivot has not paid off. And Zuckerberg just keeps spending. I mentioned this in the beginning of the video. It's a problem with the CEO where people are having concerns about, the projects he's trying to run and how they're just bleeding money and not seeing any sort of return on investment on their investment from those projects. Now I'm going to be kind of jumping in right now into why this read, you could kind of miss the story. As we know, Meta's AI CapEx is already paying off in advertising. If you ever look at Meta's, cash, they are a cash generating business. It is absolutely insane how much cash they generate. They basically own the entire media, right? They have YouTube, Instagram, all that stuff. It's insane how oh, sorry, not YouTube. What did I say? Not YouTube. They have Instagram, they own all the social media, right? So, the amount of cash they generate through advertisements is absolutely insane. Facebook too, like nuts cash generating business. Like I said, their CapEx is already paying off in advertising. The Lattice, I believe it's called, and the Gem models that they have are boosted ad conversion rates by over 6% in a single quarter. So they have great ad conversion rates, continuing to go up. So that's a great sign. And that's the first quarter kind of where, Meta quantified AI ad performance, with a specific percentage gain, right? That's the first time they did it. Ad impressions also grew 19%. And ad prices grew 12% simultaneously. So that's the cleanest possible sign of, advertising health, right? It shows that they're very strong and have a great core of their business. Their revenue also grew 33%, the fastest since 2021, right? So that's another thing you guys got to keep in mind. So to kind of translate that corporate speak into something we don't understand, it's, Meta's ROI uncertainty is showing up right now, right? It's in their core ad business. The CapEx isn't speculative. It's funding the AI that's already lifting ad revenue today. Plus, their MTIA Gen 2 with Broadcom, it's in production, which structurally lowers Meta's inference costs going forward. They're spending more on CapEx, but their per inference cost is actually dropping. So the unit economics are improving even as, gross spending arises, right? So the market is kind of punishing Meta right now for unclear ROI. And the difference between them and the other companies is that, before, like Microsoft, they got punished the past 2 quarters because there's a lot of uncertainty then. Now we're seeing kind of certainty. I believe we're going to have a little bit of a run-up, in my opinion. I've kind of called for that in my newsletters and on my channel for a while now. And with Amazon, there was potentially some uncertainty previously, but any uncertainty now is going to be wiped out by, certainty from that report that we got. The difference is with Meta is that we're getting the uncertainty now. So that's why you saw the huge dip. Plus, there was big concerns before about, the projects they're running with Zuckerberg. and seeing no return. So I think you're going to see potentially some buy the dip on here. In my opinion, I'm not going to kind of touch Meta, although they're a wonderful company. I think there's just a lot of issues that, the market and will sell off. And there's going to be some technical bearishness for a little bit here. But remember, guys, this is not financial advice. Just want to disclose that. This is, me just I'm just a guy who likes to read, do a lot of research, and then, I just present my informed opinion so you guys can make an opinion of your own. Remember, this is not financial advice, not personalized. I don't know your situation, right? So it cannot be personalized. Anyways, though, just getting that disclosure out the way. Don't want to get in trouble. Now, the next segment I want to talk about is the Agentic AI and how it's actually the real catalyst that no one is really pricing in. Here's the part of the story that I think is probably the most important one. And it's the most underappreciated, no one really knows what it means, but, please watch my other video. I did an entire deep dive on Agentic AI. It's really good. It's going to teach you guys everything you need to know about it. So before you finish this, please just go ahead and watch this or just watch it after. It's really going to, change your mind on how you view investing and what to invest in potentially, right? So, the world is kind of shifting from generative AI to, Agentic AI. And these CapEx numbers and the earnings calls only make sense if you actually understand what that is. So quickly, I'm just going to give you a quick little thing like what's the difference. So generative AI, it involves training them, right? So it's a chatbot. You ask one question, you get one answer. Agentic AI is autonomous workflow. So agents, an AI that, could book your meetings, draft your emails, queries your draft base or database, right? Executes trades, manages your code repos, all that kind of stuff, right? It's a single agentic task or like an agent that works for you that can fire 50 to 100 inference calls where a chatbot fires like 1 to 2. So it's all about inference compute, and inference compute is about to go like parabolic. It's about to be insane. And every hyperscaler is kind of positioned differently for this shift, and this is another very interesting thing. The hyperscalers themselves are positioned differently. So I'm going to firstly talk about Microsoft. In my opinion, Microsoft is the best positioned, full stop. Like, they are the best position for the shift over to inference and agentic AI. And I will explain that for you right now. So the reason for this is because Copilot at 20 million seats with Outlook level engagement, it's not a chatbot anymore, right? It's an agentic platform, that reads your emails, drafts responses, summarizes meetings, all that kind of stuff. And now with Cowork, it takes actions across all of your files. Microsoft owns the application layer, Office 365, and the infrastructure layer, which is Azure, and the model relationship through 2032 with OpenAI, and also the agent platform, which is Copilot. No one else in the entire hyperscaler business owns the 4-layer stack. They own all of it. And as enterprise shifts to agents, Microsoft collects the seat revenue and the underlying compute revenue. So they are structurally positioned best for this shift to inference. Now, Google is its technicals are amazing, and they're like, if you're technical about it, they are like a technical purist's pick for this shift to inference. And I'll explain what that means. So with Google, they have Gemini, and Gemini's long context window, with strong tool use, and their TPU itself really makes Google's infrastructure technically excellent for agent applications and implementations. The $462 billion backlog suggests, enterprises are already committing, but Google's weakness is enterprise distribution. So like the lack of market share they have. Workspace has 15 to 20% of the enterprise productivity market, versus Microsoft's sheer dominance. Like they completely dominate that market. And Google's agents work great if your company is on Google. Most aren't. Most are on Microsoft. So that's another thing too. But the Google TPU is really going to reshape it all. If they're able to really implement a TPU that is built for inference, then I think majority of these data centers are going to be buying the crap load out of these TPUs because they are insane. And there's already talks about them, taking market share away from NVIDIA, which, could potentially be a thing. But, these custom chips aren't meant to replace GPUs or CPUs. They're meant to, optimize them. And I talked about that in my other YouTube video here. So please go check that out after this one. But yeah. The next one is going to be Amazon I'm going to be talking about. So, Amazon is becoming, the picks and shovels, in my opinion, for Agentic AI. And kind of what that means is that they're making some great plays here. So Bedrock, which is Amazon software, they now host Claude, OpenAI models, Llama, Cerebrus's interface, the 2 gigawatt OpenAI commitment, the 5 gigawatt Anthropic commitment. Every major AI company is building their agents on AWS, right? So, Amazon, they don't own the application layer like, Microsoft does, but they're hosting everyone else's agents. So they win on raw cloud volume, even if Microsoft wins the productivity layer. And now lastly, Meta. This one's a little different because, they're playing an entirely different game than the other 3 major hyperscalers. Agentic AI is inside. It's going to be inside WhatsApp, Instagram, Messenger, and even like the smart glasses and the Meta glasses they have, right? So, consumer agents they're not enterprise. That's the difference. The other ones are building enterprise. They're building consumer agents. So, it's different infrastructure, and they have different infrastructure needs. They have, more inference at the edge, more multimodal. I guess the word is, their own chip, the MTIA Gen 2, is specifically optimized for inference at scale because that's where Meta's agent costs are, concentrate, right? So the point is, what I'm trying to get at here is, every single one of these companies needs massively more inference compute as agents take over from chatbots. The CapEx numbers that look scary today look conservative once agentic workloads actually scale. And you're going to see huge return on that CapEx. Remember, it's pre-funded revenue. Change the mindset on that one. Now, this next part I want to talk about is, kind of some companies that I think are going to be the cleanest plays to invest in if you don't want to get direct exposure to these hyperscalers. First things first, I think every hyperscaler kind of confirmed yesterday 2 things. They're building more data centers and they're building more custom silicon. Both of those flow directly to, drumroll please, company I've been talking about forever, Marvell and Broadcom, but Marvell in particular. Custom silicon is no longer a science project. Look at what got announced or confirmed in tonight's prints. Amazon's chip business hit a $20 billion run rate, growing triple digits. Trainium is largely sold out. OpenAI just committed to 2 gigawatts and Anthropic committed up to 5. Meta's MTIA Gen 2 is in production. It's co-developed with Broadcom. Google's TPU is funding the $462 billion cloud backlog. And Microsoft, they have their own custom silicon program, Azure Boost. They have custom CPUs, custom accelerators alongside NVIDIA and AMD. So every single hyperscaler has a credible custom silicon program now, right? So, and here's the thing though, none of them can build this stuff alone. You need custom ASICs that require, world-class IP for networking, packaging, high bandwidth interfaces, all that kind of stuff. And then IP comes from essentially 2 companies, right? Marvell and Broadcom. Excuse me. Broadcom is obviously the clear leader in the space and is already partnered with Google on TPUs and, Meta on MTIAs. Marvell is partnered with Amazon on Trainium, which is going to be huge for them, in my opinion. And other hyperscalers we haven't seen made public yet. And, there's a lot of rumors of Marvell helping Google create 2 new custom TPUs, one of which is going to be inference targeted completely. And that's just a rumor, that's speculation. So they haven't announced that yet publicly, but I believe they will eventually, So I think that's very interesting. And, as these custom silicon programs scale, both companies, they print money on every chip shipped, right? They get IP licensing, design services, and, per unit royalties that scale directly with hyperscaler CapEx. So Marvell and Broadcom have direct, IP royalty exposure, not only helping them build it, but, exposure to it through royalties too. And I didn't even touch on, the data center build out stuff, right? So, CapEx this big means one thing and one thing only. The AI super cycle is just beginning. They're going to keep making new physical infrastructure. Every new gigawatt of capacity is going to need, more optical interconnections through Marvell, Broadcom, networking switches and DPUs, high bandwidth memory through, the 3 companies I talked about in my previous videos, storage, NAND, CPUs as well, like Intel and AMD. And, Marvell and Broadcom are involved in basically every single layer. They're not just custom silicon partners. They're also the networking and interconnect fabrics that make gigawatt scale clusters actually function. So to kind of give you like a quick little gist of what they do, Essentially what it means by interconnections is, think of your body as a data center, right? You have a whole bunch of organs running through you, and you have the heart of the data center, which is, I guess, your heart in this instance, kind of pumping blood throughout your whole body. And what carries that quote unquote data or that blood across your whole bodies so it functions optimally in the data center? What is that? The veins. So think of Marvell and Broadcom as the company that goes into the data center and puts the veins of the data center, or the interconnections and the wires, in there. So that's essentially what they do inside of a data center, as well as also, helping create custom chips. Now, the difference that, Marvell has, in my opinion, is that they're making really great strides towards the future of data transfers, which is going to be photonics, transferring data through light. So that's something that you guys should really keep an eye on, in my opinion, and, pay attention more to transfers of data through light. It's going to be a huge thing. And I believe those photonics companies are all going to be reporting soon. Lumentum is one of them, so maybe keep your eye on that. I'm going to probably do a deep dive on photonics in a little bit. But Marvell is really positioning themselves to be a huge beneficiary of the push towards data transfer through light in a data center. But yeah, so as we know, like I mentioned, hyperscaler CapEx is going to be about $720 billion or $700 billion in 2026. And analysts actually believe there's going to be a huge AI boom, and CapEx is going to be going to $1 trillion in 2027. So these guys are not slowing down. They're going to be needing more data centers. They're going to be needing more custom silicon. They're going to be needing more connections and, custom, switches and DPUs. So who's going to be benefiting? Marvell and Broadcom. And I just want to make something out. I want to point something out here. Broadcom's market cap. Let's get them side by side here, actually. So Broadcom, they have a market cap of 1.2 trillion, or 1.98 trillion rather, about $2 trillion. Top 10 biggest company in the world, and they own 70 or 60% of the, switches market. In other words, the custom ASICs and, interconnecting. Marvell is a $144 billion company, and they own only 15% of the market. And like I mentioned, with this, companies are desperate. They don't care who does it necessarily. They both get the same job done. In reality, they just care that it gets done. So they don't care about price. They don't care about company. They just care if it gets done. So that's the whole point as well. That's why Marvell can see huge market share gains as well as, huge stock price gains. And they're a high growth company, which is exactly what the street likes. So I really think their earnings are going to be poised for greatness. But now I want to kind of talk about like my last little part here, which is going to be like just looking at it from the bigger picture, adding everything up. We got Microsoft 190 billion in committed capex, Meta 145, Alphabet 190, Amazon 200. That's 725 billion in 2026 capex from 4 companies only. And Alphabet just told us 2027 is going to go even higher. So this article I was kind of showing you here, this isn't a bubble, ladies and gentlemen. A bubble is when, with the dot-com bubble, we saw, valuations being stretched and demand being speculative. This is the complete opposite. These companies are kind of reporting, concrete revenue growth, contracted backlogs measured in hundreds of billions, and customers committing, that lock in CapEx returns over multi-year windows. So this is definitely not a bubble. The market is short-term punishing CapEx because it, compresses near-term cash flows. But like I mentioned, markets should be forward-looking. And that's why we saw major buy the dips. They're compressing these because they're bringing them down because, it compresses free cash flow margins. Sure, whatever. That's an okay argument. But the whole AI stack, the actual hardware companies, enabling all this, they get paid today, not in 24 months. So HBM suppliers like, SK Hynix, Micron, and Samsung, who just had wonderful earnings, by the way, they get paid today. ASIC partners, they get paid today. And optical companies get paid today. Storage companies, what do? Get paid today. The hyperscalers absorb the CapEx pain when everyone else gets concrete payments, right? So the AI stack collects the CapEx spending from that. So if they're upping their spending, no wonder we saw AMD go up 5%. No wonder we saw Marvell go up 5%. Because investors are thinking the exact same way I'm thinking and how you guys should be thinking. If CapEx is going to continue, and the only big threat to my AI supercycle thesis was going to be CapEx slowing, then who are we to think that, these companies shouldn't, reap the benefits of that CapEx or the pre-funded revenue? So it's going to be completely going up, and I believe it's going to be a bottleneck for this into 2028. So in other words, guys, like my complete honest take here is that, the market reaction today for specific companies was, in my opinion, missing the forecast from the mountains. It was completely off, except for Google. Google ripped because, they showed margin expansion alongside CapEx growth and great cloud growth too, which is the only company that proved, the AI investment is paying off right now. Microsoft, Amazon, and Meta, we'll kind of exclude Meta for this one because there's other material issues with their business, but kind of Microsoft and Amazon, they got punished for issues that don't really hold up to scrutiny, in my opinion. There's competition fears, but they completely ignore the scale and the math, right? So, free cash flow concerns, ignore the timing as well. And ROI questions, that ignore the 33% revenue growth literally show the ROI. So I don't know what more they wanted out of these companies, and I think you're going to see money starts flowing in once, the logic starts getting implemented more. We kind of already saw that today. Microsoft, as I called it in my, fire sale newsletter today, I said Microsoft's probably going to go down to 400, bounce up, look for buys there. Amazon as well, to 255. Potentially look for buys on that as well, and it went out perfectly. And I'm no genius. I just like reading a little bit, so please go subscribe to that. It's absolutely free. And yeah, guys, I just wanted to, bring this to your attention because I think this is something we all need to hear about. And there's probably a lot of you guys maybe watching this that didn't know what exactly was going on. And hopefully I cleared a few things up. If you have any questions, please drop them below in the comments. Please let me know anything else you guys want to hear. And once again, guys, please subscribe to my free newsletter. It's absolutely free. Yeah, guys, once again, take care, be smart, stay safe, stay in the green, and God bless. Have a great one, guys. Take care and enjoy.